Good morning. Come on, just a little. Hi. Thank you for having me back, and great to see you in person, in a ballroom, without masks, double vaxxed, or quadruple, or whatever the number is these days. It's good to be back in person and help the hotel industry's meeting numbers, which are looking up. I have 40 minutes. I don't have 40 minutes of slides, luckily. If you have a little sticker that says you're new, hi, nice to meet you. I'm the data guy. So they ask me back every year to talk about what the data holds. And right now, we're asking, what are the expectations as we recover? You have an app. If you want to ask me anything, don't raise your hand. That's so 2020. Ask me the question. It's going to come up right here. I guess there's a filter. So, I'm just going to get the questions that are appropriate, I guess. So there are 6 main storylines that drive the hotel industry as we embark on, the endemic phase, whatever we call it these days. Luxury, leisure travel just blew the roof off. Group demand's back. Corporate transient is a huge question mark, in my opinion. Pipeline's down. Acquisitions volume's way up. And lastly, the headache for everybody is labor, labor, labor. I'm going to talk about all those things in the next 25 minutes or so. Let's start out with room demand, straight up. How many rooms did we sell, and how does it compare to the same month in 2019? And the good news is we sold exactly as many rooms in April of this year as we did in April of 2019. The percent change is indeed 0, right? So we are rapidly recovering from the, -70, so hard to read, so terrible to read, when room demand dropped basically off the face of the earth in April of 2019. But now we're basically back to where we were, and we have full expectation that this summer we're actually going to see positive growth rates compared to 2019, just because there's just still a lot of pent-up leisure demand. And that leisure demand seems to be, what's the econ term, price inelastic. Like, it seems like the American leisure consumer doesn't care what you ask for, and they just pay. I don't know who of you here are in Miami for Formula One. Congratulations. It was wild to see individual property data come in, with room rates of whatever, $2,000 at a 3-night minimum stay. And people were like, yeah, I want that. And so we saw that up and down the coasts for the last couple of quarters, right? Leisure has been really, really strong. Leisure demand has been really, really strong. And because a lot of you are still having staffing shortages, to use sort of like 70 is the new 100, right? 70% occupancy is the new fully booked because you can't clean all the rooms. So as you hit a 50% occupancy, you're like, well, compression, here we go. And we see room rates are going up. Now, we are 14%, we're looking at the room rates that are 14% higher than they were 3 years ago. The year-over-year percent change was 36. And that's on top of 51 was April 2021 over April 2020. So huge increases in room rates. This is the 12th month, consecutive months, that we've seen ADR grow of over 33%. Wow, that's a lot. And it turns out it's not enough. Inflation is a thing, it's real, and it's taking a huge bite out of the nominal ADR. So what I'm showing you here is ADR recovery in the past to the Great Recession and then the post 9/11 recession. How long did it take the industry to get back to real ADR, so inflation-adjusted ADR, of either the year 2000 or either 2007, right? And post 9/11, it took, call it 60 months, and in the Great Recession, it took, 80 months or so. And wow, we are only 2 years into it, and we're basically already almost back. But almost is actually the term here, because we won't hit that until 2025. But that said, we're getting there very, very quickly, compared to other recessions, just because there's so much nominal pricing power. So that's quite impressive. Now, if we cut out housekeeping, and if airline fares go up, so the total cost of travel goes way up, and we don't provide the services, is the American consumer saying, whoa, this is really not a good value? That's the question for the summer and the fall and for next year or so. But right now, this is really, really strong performance. When you break this out, I normally show you data by class or by scale. I'm switching it here, and I'm looking at location types, because I think it tells an interesting story. So we're breaking out all zip codes in the US are being slotted into a location type. So we have small town metro, which is like everything else. We didn't know what to call it. But so urban is obviously downtown, suburban, you get the idea, airport. The point here is the occupancies in April for urban and airport hotels are still not as strong as they were in 2019, to me implying that the individual business traveler is still lagging, is still not quite back to where it was. The resort occupancy is actually not where it was, but it's almost there, right? Because as we talked about, and as you see in your own data, very, very healthy leisure demand. But look at what happened to the room rate over the last 3 years. So we're able to drive resort room rate by, that's a lot of numbers, I can't do it that quick, call it $66. So over 3 years, we're able to grow room rate $20 year over year over year over year, in the resort side. And when I talk to resort operators, they're like, yeah, we're not stopping. We're fine taking the hit on the occupancy, because our wages and all the other costs are going up so much. What's a little worrisome maybe is on the urban side. You see that there are some signs of life on the room rate side for the urban hotels, but that's really not a whole lot. And a lot of this is actually weekend driven. So there has been quite a lot of leisure demand in urban hotels. I'm based in Bachelorette capital USA, Nashville, Tennessee. Our weekends start on Thursday, when the bachelorettes come tumbling out of Southwest flights with their white cowboy boots, and they're driving up, leisure in downtown locations. So what I'm worried about that ADR number for the urban properties is what happens when the corporate renegotiated rate and the group discounted rate come back together in the mix. We may not see as strong of urban room growth rate as we have seen. So that's definitely something I'm paying attention to. On the resort side, I'm just like, yeah, whatever. I can't go. I can't afford that. So I hope that a lot of American leisure travelers will. So leisure is strong, and group is honestly, for me, a little surprisingly strong. So this is a small subset. This is just for the high-end hotels, luxury and upper upscale hotels, so the big boxes. And we're asking them, is the room that you're selling sold in increments of 10 or more, what's called group, or transient is the corollary, group rooms between 1 and 9. So 10 or more rooms sold, and you're seeing that we're in April of this year only 1 million group rooms short of where we were at prior peak. So I think that's really, really encouraging. I think this plays into a larger theme that we will get to in a minute. But to me, group, and especially association travel, is what's going to be really, really healthy, just because this is so efficient, right? You can set up 6 meetings, and you don't have to go to 6 different cities. You just switch seats. For breakfast. The publicly traded companies, this is a terrible slide. This is not a slide, this is a handout, as I like to say. So you don't have to read it. I'll read you the 3 sentences that matter. But in the Q1 earnings calls, the big publicly traded companies that deal a lot with groups had interesting things to say about their forward-looking data. So group revenue pace, Marriott said, for the remainder of 22 was down high single digits. Hilton is saying group revenue booked in Q1 was down just 4% compared to 19. And Ryman's saying they basically are only 3% off the group rooms that they booked at the same time in 2019. So mid to high single digit decline compared to 2019. I think that's phenomenal, right? We're coming out of the pandemic-related lockdowns when CEOs were the chief risk officers and they're like, you may not travel, everybody at home, everybody get their shots, do a Zoom call. And people are like, I'm sick of Zoom calls, Like we all want to go back out together. And I think the public traded companies are seeing that in their bookings, on the group side specifically. Now, I was interviewed for some of the major newspapers about business travel. And the tenor, not just from me, but from the other expert that they asked, was decidedly lukewarm. Business travel resumes just not its former pace. The hottest day is Wednesday, right? We're all going back into the office Wednesday. Who is in the office 5 days a week? 1, 2, 3, 4, 5. That used to be me. Costar was hardcore. They're like, you gotta be double boosted, plus in the office 5 days, no exceptions. And guess what? We couldn't hire any IT professionals. I wonder why. So when Jamie Dimon, from JP Morgan said, 5 days in the office, oh, I'm actually just kidding. It's 5 days if you're client facing. Everybody else can do, whatever, hybrid. We suddenly switched also to hybrid. Who here is totally remote? Doesn't even have an office, right? So thank you, that's fascinating. And that's the future? I don't know. I like the office. Our coffee maker is awesome. And honestly, it's better than at home. So I like going into the office. My commute is 20 minutes. Like, I don't care really. But that's so interesting, right? If you're not in the office, right, how do you build culture? Right? You have to get together. And so what I think a positive side effect of this trend of not being in the office or only being in the office a few days a week is this trend to meetings, to smaller meetings, to just get together. And I think hotels could really benefit from that. By having, your Eastern sales force gets together once a quarter or so, and they all meet in the same ballroom in Orlando. You do a little programming around it. It's 2 nights in and out. Nobody gets hurt. And, people are like, hey, this is how we build culture now because we are not around the water cooler anymore. And it's really hard to do it over Zoom and Teams. I tried, and it's really hard to be funny on Teams. It's easier to be drunk and funny in a bar. Not that I would know that, but I'm just hearing that. So, I think that could really be an upside for the hotel industry. And this is also super interesting, I think. Now, I made the slide, so I hope it is. But so I'm now with Costar, right? I used to be with STR for 20 years. Now I'm with Costar, and Costar is the premier provider of commercial real estate data. So we have like this huge data lake they can paddle in and look at. And we track information about office sublet space. So when the COO or the head of real estate says, hey, we're having all these virtual people, we don't need 12 floors anymore. But our lease goes another 6 years. Can we just, let's sublet it. And they put it on an auction platform or on a LoopNet, a platform that we own, and we can track this. In January 2019, in the first quarter of 2019, sublet space was around 37 million square feet in the United States. Now it's 67 million square feet with, you see, with an acceleration. Because people are saying, look, I don't need that space anymore. Even when we go back to normal, whatever that means, we don't need all the space that we used to have. Because if we want to get people together, we'll just book a ballroom, hopefully. So then, to me, the implication is, if you don't have that space, that probably means you don't have a lot of those people in the office. That probably means that there won't be a lot of business travel inbound on a Tuesday, Wednesday to meet with those people because they're in their PJs in their kitchen in Hoboken. So they aren't going to meet them there. So what we're seeing here is the urban upper upscale class occupancy compared to 2019 is still 37% below where it was. And you see that that number isn't, I mean, it used to recover quite nicely, and now it's sort of stalling out. And in my little head, I make up a relationship there. I'm saying fewer people downtown in the office means less need for travel. So to me, return to office and corporate transit demand are connected at the hip. And right now, it looks like we're not going to go back to the 2019 numbers that we had seen. Now again, the upside might be more smaller meetings, and we talked this morning for breakfast, isn't it also possible that we misclassifying, the people who are coming in on Thursday, they're actually working in their hotel room, but they're classified as leisure, right, because they're partying all the way through Sunday, after the Zoom call is over at noon on Thursday, whatever. So is it possible that we have some false positives there? Yeah, that's certainly possible. This bleisure term or whatever we call that these days, that certainly has an impact. But I don't think it moves this needle. We just have less office space that people go to, and I think that will have an impact on occupancies. Switching to pipelines and acquisitions, the number of rooms in construction is 150,000-ish or so. You see that number has decelerated. Why is that? Because hotels that are in construction are opening, and hotels that are in final planning are not breaking ground. For a variety of reasons, things just got more expensive, right? Interest rates went up. Your doors and TVs are on the slow boat from China, literally, and you don't have any people, because everybody's building multifamily, and there's no concrete to be had in Vegas, and stuff like that. So we're going to see a slowing of the pipeline. Are we going to go down to 50,000 rooms like we saw post-Great Recession? I doubt it. I think we're going to see more of a deceleration, and then it's going to pick back up. Where are people building? Whoa, New York. That's a lot. That's over 10% of rooms. That's a lot. So why is that? Not to get into politics, but the city council created an ordinance that had a huge impact on developers. Developers wanted to come in under the wire, so a lot of stuff broke ground very, very quickly. So it's sort of like the python that eat the pig, like there's going to be a bump and then not a whole lot coming in. Nashville, Tennessee, y'all, where I'm based, and it's all luxury. It's crazy town there. It's Four Seasons. The Ritz-Carlton is probably going to make it. Fairmont, the Conrad will open like in a couple of days. It's all just high-end stuff, in Nashville. What gives me pause on that slide, if I look at DC, Seattle, Chicago, San Francisco, markets that have not yet recovered, that are still seeing a lot of struggles on the demand side. They're now seeing new supply coming as well. So that's going to be really tough for occupancy and then therefore tough for rates. So there is definitely here a tale of two cities. If you're leisure driven, you have done really well. You will continue to do quite well. If you're group and corporate transient driven, the verdict is still out. And you saw, in Seattle that Amazon said, hey, don't come to our downtown headquarters, go to a different office. We're not quite sure that we like downtown right now. So hopefully by the time you get there, it's going to be fine. But it's definitely something that gives, me pause as an observer. On the acquisition side, last year was the single strongest deal volume we've ever recorded. $50 billion traded hands. Blackstone was like part of all of it. No, that's not true, but most of it. And there were a bunch of deals where Vichy, which is a REIT, took casinos over and then leased them right back. So there's some noise in the data. But still, 50 billion in a year of a pandemic, so that's pretty strong. And Q1 was $13 billion in asset sales. So there's a lot of activity. There's a lot of interest. And I'm like really excited and share this with our other national director, the guy who runs the industrial space, and he's like, 13 billion, dude, I do that in a month. I'm like, yeah, but we're so, for us, that's really good. He's like, yeah, go play hotel. So we don't really matter in the big CRE world, but this is a really, really strong number. It's the strongest Q1 results that we've seen since 2016. Just briefly, 2 examples that give you a sense of where the investor mindset is today. Of course, Nashville had to do that. So the W Hotel with no operating history, I mean, it opened 5 months before it was sold. Sold for $1 million a key. Well, $950,000, which includes a lot of food and beverage because this is arguably an urban leisure destination. I talked about the Bachelorettes. Their rooftop is legitimately too big for the hotel. But the reason is they're like, no, they're all going to come, and have $20 martinis, and they are, and that's what somebody underwrote. The opposite, the polar opposite, is that Host bought the 3rd largest hotel in New York City, 1,800 rooms, in 2006 for $740 million, and just took a total haircut and sold it for $360 million to a company called MCR, Tyler Morse, who owns the TWA Hotel. I wrote a REIT commentator who said, the valuation implies that Manhattan will fall into the ocean. Obviously, they have very different perspectives, on what a midtown large meeting box will do. And Host is saying, we're out. It needs a lot of love, a lot of FF&E, a lot of, brand standard money. And Tyler Morse is like, no, I think at that base, I can make this work. Because, and we talked about this over breakfast as well, when you look at the pipeline, it's all limited service, right? My chart used to say we're not building ballrooms anymore because we're not. This is super rare, So if you can get in on a good basis in the 3rd largest hotel in New York, maybe this makes sense. Ask me in 5 years, But this is a super interesting polar opposite bet, that Host is making and that MCR is making. So that's sort of a sentiment of where investors are. If it's leisure, it absolutely pays top dollars. And then the question I get all the time is, what about the distress? What about the distress? And I'm like, there is no distress. So in Q1, we sold 9% of all asset sales were distress. You see that there was a blip in Q1, so in Q2 of 2020. That is on a very, very small base. There were no deals. So of those no deals, 1/3 of them were distressed. Okay, whoop-de-doo. But there's really not this tsunami of distress that everybody was expecting, right? That owners would be forced to shut down. Because the bankers that I talked to, they were like, look, it's not the operator's fault, So we just extend and pretend, and now a lot of those loans are made whole again. And so we're not going to see a lot of distress. But then, of course, the distress is on the labor side. And you're living this, I'm hearing about it all the time. This is the #1 topic, and I will see some of you in NYU in 2 weeks ago. Every single panel, and this is an investment conference, every single panel will talk about this. This is the BLS data. They're saying there are 300,000 workers lagging. The HLA number is like 4x that. They count things slightly differently. But the point is, we don't have enough people. And when I talk to developers, I say, I have no doubt that you can buy the land, plan the room, finance the room, maybe even construct the room. But who's going to clean the room? That's the question. And so in limited service hotels, I don't think we're going to see housekeeping again, period, done. And in high-end hotels, they're calling it now, you probably know this, a tidy, where they're taking out the trash. That's it. Thank you very much. And you can do whatever, 50 rooms in an hour or something. Because we just have such a hard time finding people. So what does this mean then? And this is from our friends at Hotel Effectiveness here based in Atlanta. I think they have the best labor data out there. So if you're looking for that data, talk to Taylor. So this is just new wages. But you're seeing, look at this, double-digit increases, for most of the positions. This is not going anywhere. So yeah, we can drive room rate by 30%, but everything is getting more expensive, especially labor, if we can find it. And then of course our guest sat scores are going way down because people don't get the service that they think that they deserve based on what they pay. This is a huge issue that's not going to resolve itself overnight, and I'm very curious to see what else the industry comes up with to tackle this. Let me finish with the forecast. This will be revised by Amanda Height of STR at the NYU Hotel Investment Conference. Not a big surprise, right? So occupancy, we're basically saying we're hitting the 2019 occupancy at the end of 2022. We've always sort of said that, and we think that's going to be true. Room rates, we're already way above where we were in 2019. So 100 is basically the 2019 level. And we're going to revise this up because Q1 data was so strong. And then you're seeing the RevPAR number following accordingly. So that in 2025, we're up 30%. In nominal terms, if you adjust it for inflation, you get the real terms. And we're proposing in this forecast, we're not even hitting 2019 real ADR until past 2025. In the new forecast, we will say we'll hit it in kind of ish 2025. So inflation plays a huge role, and your owners are not super happy because driving the top line does not necessarily mean you can drive the bottom line, because everything in the middle, all the expenses, are going to continue to spiral. So leisure super strong, group healthy, hopefully healthier coming. Return to office / corporate transient, a big question mark in my opinion. Pipeline slower, investment activity way up, especially for leisure-driven resorts. And labor, getting labor, figuring out labor is the question of the moment. With that said, thank you so much for your time. And I'm happy to take, lots of questions. So, text away, or type away. Hi, Chinmay. Is Costar tracking any vacation rentals, alternative lodging metrics currently? We are not. AirDNA does it really well. Jamie Lane, formerly CBRE, is the head data head, super good guy. He publishes really well on LinkedIn, as do I. Follow me on LinkedIn. Like, I publish stuff all the time. So we don't have the alternative accommodation metrics, but the question is, what's the impact? If we had it, what was the impact? The only way I can answer that is that I only ever say, in 2019, Airbnb and VRBO did really well, right? And the hotel industry had its best year ever. We sold more rooms than ever. So I don't really see the impact. Now, the year 2020, the Great American Road Trip, we all learned what Airbnb is, right? And they immediately went public with that, So they did really well in 2020, 2021. Will we see sort of a siphoning off effect? I don't know. And I always use my mother-in-law as the example here because she had a birthday. I'm not saying which one, but she had a birthday. And she's like, I want everybody to get together. I'm like, oh, should we get a house? And she's like, I'm not cooking. Right? I'm like, oh, true, duh. So we went to a super, super swanky hotel, and everything was paid for, and somebody else cooked for her. So the point is, I think a lot of people have had home cooking for 2 years, and they're like, let somebody else cook and make a bed. And so I think Airbnb works. In certain situations. I think it all worked when we were trying not to be amongst other people. I think there's a place for it in the ecosystem, no doubt about it. VRBO and the other providers. But I think hotels have a very clear place in that as well. And is there going to be like a trade-off, between on the leisure side? Yeah, I think people make the decision that works. When I travel on business, I'm not sure I'm even allowed, to stay. Like, it's not even on my Concur. It doesn't come up, so I can't book it. So I think it's going to be tough for them to get into the business travel side. Do you have any data supporting the continued requirements of negative COVID tests to enter a couple of countries, certain countries? There is no international travel really into the US today. I mean, there's some. I'm digging into that right now. The University of Oxford actually has a stringency index. I never knew this, but I have great analysts who know these things. And you can actually correlate by state occupancy with their strictness. And I'm doing this for the Hotel Data Conference, plug, end of August, Nashville, Tennessee, y'all. And I don't know yet what the data shows, but I'll definitely dig into that. Are investors moving away from city centers? Is real estate more attractive to property owners? Are investors moving away from city centers? Right? It depends. You know, if you believe in your core that meetings will do well and that eventually the American business travel will come back, then no, the city center is where it's at. But that's a bet, right? Real estate is always a bet. You have to have conviction, you know, and you absolutely have a ton of people on that side of the bet. And you have a ton of mostly publicly traded REITs who are like, we're out, you know? And we like leisure because it seems that leisure is literally recession resistant, you know? Like, I think we were all sort of shocked at the amount of travel that happened while the CEO said, you can't travel on my dime, stay home. And everybody said, yeah, but on my dime, it's different. Like, I'm a different person Monday through Thursday, you know, and then I'm a different traveler Friday, Saturday. When I pay, I want to go. Our guest satisfaction score is declining. I hear this anecdotally. I don't have that data, but I bet there's somebody in the audience who knows this because they have the data. But I'm just hearing that guests gave hotels a lot of leeway and said, you know what, it's a pandemic, it's fine, I get it. But now they're like, okay, it's not fine. You're charging me 33% more than you did a year ago, which is 51% higher than it was a year before that. Clean my darn room, or whatever, serve me something. Don't have, you know, restaurants open, you know, between 8 and 12. You know, I demand respect and I demand services. So I think we will see this in the data. I can only tell you what I'm hearing anecdotally. What are the top 2 to 3 recovery trends for EMEA? So EMEA is super hard to make a statement about. Middle East has been absolutely the winner coming out of the pandemic. Room rates there, in the US, it's up 14% over 2019. In the Middle East, it's up 30%. You know, so super, super strong room rate growth. Yes, driven by the World Expo, but other events as well. You know, they've really, really, really driven room demand for leisure, for corporate, and for group quite well, and we're seeing that in the data. Europe is really tough, right? The closer you get east, the more people think you're at war, which Poland is not at war. But are a lot of Americans going to Poland just for fun? No. You know, so we're seeing the Paris numbers pick up, the London numbers pick up, but then when you get into the mainland and a little bit further, it's just really, really tough. You know, with the Ukrainian invasion not going anywhere, apparently, that seems to be sort of a status. So a lot of travelers are saying, well, let me just stay, you know, France, you know, Spain, Portugal. Those are doing quite well. Those numbers were all supported by domestic travel, you know, in the last 2 years. Just like in the US, when there was no international travel, the domestic leisure traveler really picked up quite well and paid for it. So we saw basically that same trend all around the world. How soon will inflation curb demand? Will leisure behave different than corporate business? I think we saw in 2020 that leisure behaved very different from corporate business. But there is also maybe something a little bit of what's called the wealth effect, that you feel wealthier just because your 401k and your stock market, even though you're not trading, but your portfolio went up and you're like, woohoo, you know, let's spend the money I haven't traded, it's just in the bank, but let me just spend some of that money, you know? And so I think, yes, we will see continued pent-up demand on that side, but I don't know if inflation, if everything gets more expensive and the total cost of travel, air, hotel, car, together will curb demand, or will people just trade, right? And you don't take the ocean view room anymore, you take the back view, you know, which is a little bit cheaper. And you don't go out all the time, you do maybe 1 or 2 Uber Eats, or, you know, maybe you just trade. That we don't know yet. Historically, Higher gas prices have no impact on room demand. I know that's the second question that you probably wonder. I can tell you it does not. So I'm out of time. I really appreciate your time, you inviting me back. Have a wonderful rest of the conference. Thank you very much.